Welcome to the Deep Dive, where we cut through the noise and get straight to the insight that truly matter. For anyone tracking the pulse of the global economy, 2025 is shaping up to be, well, a really pivotal year, a crossroads of unprecedented change and critical decisions in the financial sector. And these will ripple out to affect everything from global banks right down to your individual savings. Today, we're embarking on a crucial deep dive into the major shifts happening across banking, finance, and insurance. To guide us, we've pulled together a comprehensive Deloitte report on the banking regulatory outlook, Monexa AI's pretty incisive analysis of Goldman Sachs' strategic moves, an expert take on the fascinating evolution of the Fintech bank relationship, and a revealing Marsh report on U.S. insurance market rates. Quite a mix, our mission. To distill what's truly important from these diverse sources, offering you those aha moments and hopefully arming you with actionable insights. Consider this your shortcut to being genuinely well-informed about the powerful financial forces shaping our world. Okay, let's jump right in. The Deloitte report highlights a stable supervisory environment with some important changes to the direction of regulatory policy. But what does that really mean for financial institutions, especially with, a potential shift in U.S. political leadership on the horizon?
That's the core question, isn't it? And what's fascinating here is how deeply U.S. elections and Supreme Court decisions are intertwined with the day-to-day operations of banks. It's not just about the economy, it's about the legal and political groundwork underpinning it all. So if we see a second Trump administration, the Deloitte outlook anticipates a clear focus on deregulatory efforts. And this isn't just theory, it could mean significant revisions or even a complete rollback of proposals like the Basel III Endgame.
Hold on, let's unpack that a bit. For those less steeped in the jargon, what exactly is the Basel III Endgame?
Good question. Basel III Endgame refers to a set of international banking regulations, basically designed to strengthen capital requirements for large banks. The aim is to make them more resilient to financial shocks, like we saw back in 2008. But it's faced widespread criticism from the industry for being, overly burdensome and potentially stifling lending.
Okay, so potentially less capital required.
Potentially, yes. So a rollback would mean different rules for how much capital banks need to hold. That directly impacts their balance sheets and their risk profiles. We could also see the Consumer Financial Protection Bureau, the CFPB's open banking rule, or maybe the Office of the Controller of the Currencies, the OCC's recovery planning guidelines, undergo significant revisions too. And it's not just the top political office. Leadership shifts at key agencies like the OCC, the CFPB, and the FDIC, that's the Federal Deposit Insurance Corporation, they can drastically alter policy direction. For instance, Travis Hill recently became acting chairman of the FDIC, and Michael Barr announced his resignation from the Fed's vice chair for supervision role. These shifts, even if the day-to-day staff remain pretty consistent, allow new administrations to really influence the regulatory agenda in a big way.
This sounds like a lot of moving parts. It really does. But what about the Supreme Court? These legal shifts, they might seem academic, right? How do they really trickle down to impact the bank's operations or even us as consumers?
You're absolutely right to connect those dots. These legal decisions, while they might seem academic, have profound practical implications. Take the overturning of the Chevron doctrine, for example. Previously, courts typically deferred to agencies like the Fed or the FDIC when they interpreted ambiguous statutes. That was the standard. Now, agencies will receive less judicial deference.
So less automatic trust from the courts for these regulatory bodies. Is that fair to say?
Precisely. Yeah, that's a good way to put it. This could lead to far more successful legal challenges to new financial services regulations. Then there's the corner post decision. This allows litigation claims to accrue from the time of injury, not just from when an agency takes action.
Okay, and for you listening, what does that mean?
Well, it means potentially a less stable and more unpredictable regulatory environment. Banks face greater legal uncertainty when new rules are issued, and that can impact the types of financial products available, or maybe even how quickly new innovations can be brought to market. It introduces a real sense of unpredictability. Adding to these difficulties, we're seeing an elevated risk of regulatory fragmentation. Interagency coordination, which is, vital for a coherent financial system, seems to have stalled in some crucial areas.
Like what? What does fragmentation look like in practice? You give an example?
Sure. A prime example is bank merger reviews. The FDIC and the OCC have finalized separate proposals to amend their procedures, but the Federal Reserve, the FRB, declined to update its analysis, so you have divergence.
Okay.
This leads to inconsistent or varying regulatory expectations across these agencies. What it means is that two very similar banks could face different standards and requirements based simply on which agency charters and primarily supervises them. It creates complexity and, frankly, potential for regulatory arbitrage.
So with all this uncertainty swirling around, from potential political shifts to a more assertive Supreme Court and fragmented regulatory approaches, what does this all mean for banks trying to plan their future? How do they navigate such a volatile landscape?
That's a really important question. How do banks navigate this uncertainty while still meeting strict supervisory expectations? It's tough. Post the spring 2023 bank failures, supervisors are now adopting a far more assertive stance. No question about it. They're identifying issues faster, setting ambitious remediation dates, and escalating findings much more quickly into enforcement actions. We've seen a dramatic surge in public enforcement actions. They nearly tripled in the latter half of 2023 compared to the first half, and they've remained elevated into 2024.
Wow, tripled.
Yeah. The real insight here for you listening is that failure to address these issues quickly could land a bank in a kind of regulatory penalty box. And that can take years and millions, literally millions, to escape, impacting their reputation and their ability to innovate. Beyond just fixing problems, financial resilience remains absolutely top of mind. Let's revisit that Basel III endgame proposal we mentioned earlier. It received widespread criticism, as I said, and it's now widely expected to be significantly revised or even withdrawn, likely in favor of a more capital-neutral form.
So the initial more stringent push for capital might be softening. What's the thinking behind that potential pivot? Is it just industry pressure?
Well, industry pressure is certainly part of it, exactly. This expected pivot signals a clear industry win, you could say, in the ongoing debate over balancing financial stability with economic growth. The insight here is that the political and economic appetite for what some consider excessive capital requirements, particularly for mid-sized banks, seems to be waning. It suggests a kind of recalibration of post-2008 regulatory ambitions. Another key area is long-term debt, or LTD, requirements. These are now being extended to a broader range of institutions, specifically non-G-SIBs. That means large banks that aren't designated as global systemically important banks, but still hold over $100 billion in assets.
Okay, so spreading the requirements wider.
Right. This expansion signals a crucial shift in regulatory thinking. It's aiming to bolster the resilience of a wider segment of the financial system, but it could lead to a substantial $70 billion shortfall in existing debt issuance for these institutions.
$70 billion, that's huge.
It is. It means they'll need to issue a lot more debt, potentially increasing their funding costs.
And when it comes to liquidity, which was such a critical concern after those bank failures, how are regulators addressing that side of financial resilience?
Yeah, liquidity is under intense scrutiny. Regulators are closely evaluating liquidity frameworks. The Federal Reserve has launched a review of its discount window operations, asking for feedback on how banks pledge collateral and access loans. The FDIC has also proposed broadening brokered deposit definitions, which could reclassify, get this, up to 30% more deposits as brokered.
30% more? Wow. How does that impact banks?
Well, it impacts some banks' funding models quite significantly and how they manage their balance sheets. There are also discussions around requiring banks to pre-position collateral at the discount window, making it easier and faster to access emergency funding if needed.
And here's something interesting, maybe even surprising. There's actually bipartisan appetite for requiring or incentivizing banks to establish easier access to the discount window and regularly test their readiness. Senator Mark Warner's legislative proposals highlight this. This isn't just a regulatory idea. It seems to have genuine congressional backing across the aisle.
That bipartisan support really underscores the severity of the liquidity lessons learned from 2023.
Absolutely. So, stepping back for a moment, all these changes from stricter remediation and enforcement to adjustments in capital and liquidity rules, they translate into significantly higher operational costs, and they compel major strategic adjustments for banks. This, in turn, directly impacts their competitiveness and ultimately the services they can offer you. Okay, so we've covered the macro environment, the operational pressures, the push for financial resilience. Now, the Deloitte report also points to some fascinating and frankly rapidly evolving non-financial risks, things like cyber threats and the burgeoning impact of artificial intelligence. These feel less like numbers on a balance sheet and more like an invisible battleground almost.
You're right, and what's fascinating here is how technology is truly a double-edged sword. It really is. On one side, you have cybersecurity. Threats are just growing in sophistication, driven by geopolitical tensions, even state-sponsored attacks. Banks face immense challenges, especially if they're running on older legacy systems. So operational resilience is key. It's about not just preventing attacks, but defining precise recovery times and rigorously demonstrating the ability to meet them after a breach actually happens. Then there's financial crime and fraud. Criminal methods are constantly evolving. It's like a constant arms race. We see sophisticated ransomware as a service models, targeted phishing campaigns using things like QR codes, or even intercepting one-time passwords. We're also seeing increased consumer fraud related to real-time payment systems like FedNow, which offer speed, but also, unfortunately, new vulnerabilities for fraudsters to exploit.
That sounds like a constant game of cat and mouse.
Yeah.
Exhausting. And I imagine relying on external partners for technology or services only adds another layer of complexity.
Absolutely. Third-party risk management, or TPRM, is a huge focus now. Regulators are really scrutinizing the connection points between banks and their non-bank service providers, the tech vendors, the cloud providers, you name it. We've seen the FDIC propose greater record-keeping for third-party non-bank deposits, and we've even seen enforcement actions against banking-as-a-service, or BaaS, partner banks for essentially inadequate oversight of these crucial relationships. It's really about ensuring the weakest link doesn't bring down the whole chain.
Makes sense.
And this brings us neatly to artificial intelligence. AI is truly both a weapon and a tool, as Deloitte puts it. It can amplify risks, making cyber attacks more potent or enabling hyper-realistic deepfake fraud that mimics voices, posing huge challenges to identity validation. Imagine trying to verify someone over the phone if a deepfake sounds exactly like them.
Scary stuff.
It is. But AI also offers immense potential for efficiency in areas like fraud detection itself, personalized services, automating compliance tasks. The list goes on. The Treasury Department has even issued a request for information, an RFI, on AI in financial services, and the Financial Stability Board is calling for enhanced monitoring globally. For you, the question of whether AI is a weapon or a tool for the financial industry has become really significant recently. How banks integrate it into their risk management will directly impact everything from your fraud protection to the new kinds of services that might become available.
That's a critical point. We've explored how AI amplifies cyber risks and fraud. But what does this mean for the companies whose business is to insure against these very risks? You might logically expect cyber insurance rates to be skyrocketing, right, given everything you just said.
That's a great question, and it's logical to think that. But the Marsh report on U.S. insurance rates for Q1 2025 gives us some really counterintuitive insights here. While AI definitely amplifies cyber risks, cyber insurance rates actually decreased by 4%.
Decreased?
Yes, decreased. This marks the 8th consecutive quarter of reductions. It's largely driven by increased market capacity, more insurers getting into the game, and new entrants competing. The interesting takeaway, though, is that clients are using these premium savings to secure higher limits and broader coverage. So they're reinvesting the savings into better protection, indicating a more mature and competitive market overall.
That's genuinely surprising, especially given all the headlines we constantly hear about massive cyber threats. So cyber is down, but what about other areas of insurance? Are they following suit?
Well, no, it's a mixed bag. Contrast that cyber trend with casualty rates. They saw a notable increase of 8% overall, and actually 12% if you exclude workers' compensation.
Okay, why the jump there?
This rise is largely due to larger jury verdicts nationwide. You hear about these nuclear verdicts, particularly in auto liability, and just generally rising repair costs for vehicles. There are also increasing concerns about third-party litigation funding in the U.S. court system, which many argue is driving up claim costs artificially. Property rates, however, saw a 9% decline, mostly due to strong competition among insurers. And financial and professional lines also experienced a small 3% decrease overall. However, even within those declines, D&O, that's directors and officers liability, and fiduciary insurance still face specific challenges from high litigation costs and a generally cautious underwriting approach. So this divergence in market trends highlights a fascinating recalibration of risk perception across different segments of the insurance world.
Okay, so we've covered the macro environment, the operational pressures banks are under, and these tech-driven risks, including the surprising dynamics of the insurance market. Now let's zoom out a bit to the strategic shifts reshaping the entire industry. First, that fascinating evolution of the relationship between fintechs and traditional banks. It used to feel like a stark competition, didn't it? David versus Goliath.
It absolutely did. That was the narrative for years. But if we connect this to the bigger picture now, it's really no longer a David versus Goliath story. It's morphed into what Luigi Wiwiger, an expert in this area, describes aptly as co-opetition. A mix of cooperation and competition.
Oh, competition. I like that.
Yeah. Fintechs, with their agility, innovation, and frankly better customer-centric approach, initially found traditional banks slow and bureaucratic. Banks, in turn, kind of recognized that fintechs could move faster and fill gaps they couldn't easily address. Now there's more of a mutual recognition of strength. Fintechs bring the innovation spark, while banks offer the scale, the customer trust built over decades, and crucially, the regulatory expertise and licenses.
So how does that collaboration actually manifest? What are some concrete examples we'd see as consumers or users?
We're seeing it in several key areas. Open banking is a big one, where APIs, application programming interfaces, enable seamless integration of fintech solutions into existing bank infrastructure. This allows for enhanced services for you. Digital payments and lending are obvious ones, where banks often provide the regulated backbone and the capital, while fintechs offer the slick, user-friendly interfaces. Even in advanced risk management and fraud prevention, banks are increasingly leveraging sophisticated AI-driven analytics developed by specialized fintechs.
Right.
This collaboration is even making strides in financial inclusion, helping to reach unbanked or underbanked populations more effectively than either could alone. Of course, it's not all smooth sailing. There are hurdles, significant cultural differences between nimble startups and large institutions, technological incompatibilities sometimes, and navigating the very stringent regulatory and data privacy concerns remains a constant challenge. And adding another layer of complexity, as if we needed one, is the entry of big tech companies, Google, Amazon, Apple, into financial services.
Right, the giants.
Their massive user bases and data capabilities are pushing both banks and fintechs into new strategic alliances just to compete or partner effectively. The future is really looking like a hybrid ecosystem. It's characterized by concepts like embedded finance, where financial services are integrated seamlessly into non-financial platforms and making payments directly within an e-commerce app or getting insurance when you buy a plane ticket. And then there's the nascent but potentially huge potential of decentralized finance, or DeFi, which operates on blockchain technology, often without traditional intermediaries. That's a whole other deep dive, maybe.
Maybe so.
But the key point for you, the listener, is that this collaboration between former rivals, this co-opetition, is directly impacting how innovative, how personalized, and how accessible your financial services are becoming.
That's a powerful shift across the entire financial ecosystem.
Absolutely.
Now let's zoom in on a major player, Goldman Sachs, to see how these forces are playing out in real time. We've got that Monexa AI report. How does a global institution like Goldman adapt to all these pressures and opportunities we've been discussing?
That's an excellent question, and looking at a specific firm really grounds these trends. The Monexa AI report shows Goldman Sachs making some interesting strategic investments in sustainable and innovative sectors. For example, they're investing in renewable energy, like HydroStore's advanced compressed air energy storage technology, pretty cutting-edge stuff, and also in construction technology, like Trackinit. This aligns with broader ESG, environmental, social, and governance principles, demonstrating a clear commitment to future-focused sectors.
Okay, so future-proofing investments. What else?
Well, on the other side, there's also a noteworthy policy shift mentioned. Goldman Sachs apparently removed diversity targets from a key regulatory filing, and the report links this timing to an executive order by President Trump. This has certainly sparked debate among investors about the balance between, board diversity goals and purely merit-based appointments, especially given Goldman's past public advocacy for diversity initiatives.
Yeah, that highlights the complexities these global institutions face navigating political and social pressures, doesn't it?
It really does.
And what about the bread and butter business, the macroeconomic forces? How are factors like inflation or interest rates impacting a giant like Goldman?
Well, Goldman Sachs's M&A mergers and acquisitions advisory revenue is heavily influenced by these macro factors. It's a cyclical business. While a solid U.S. GDP growth of around 2.4% is forecasted for 2025, which is generally good news, potential import tariffs by the Trump administration, if implemented, might keep inflation elevated. And sustained higher inflation, or uncertainty about it, can definitely impact deal-making activities. Companies tend to become more cautious with valuations and financing costs go up.
Right, puts a damper on big deals.
Exactly. Another area of strategic focus highlighted for Goldman is wealth management. While they heavily rely on securities trading, that's historically been their engine, there's seen to be a substantial opportunity to grow their wealth management segment significantly. Competitors like Morgan Stanley, for instance, have asset and wealth management revenues that are apparently 3 times Goldman's in that segment. So it signals a clear area for potential strategic expansion and catching up.
Interesting. A shift in focus, perhaps.
Potentially, or at least a rebalancing. And finally, on leadership, John Waldron's appointment to the board and a significant retention bonus signal leadership stability. It positions him as a likely successor to the current CEO, David Solomon, providing continuity, which is always important in these dynamic times.
Okay, we've truly taken a deep dive today, haven't we? Uncovering this intricate tapestry of financial change expected in 2025. From the shifting sands of regulation and that intense pressure for banks to remediate issues faster, to the double-edged sword of AI and those surprising dynamics in the insurance markets, it's clear the financial world is anything but static. Far from it.
Absolutely. And we've seen how these macro and micro forces are shaping the strategic decisions of major institutions like Goldman Sachs, driving both adaptation, like those ESG investments, and unexpected shifts in policy and focus as they navigate this complex landscape of co-opetition and rapidly evolving risk.
So here's a final thought for you, our listener, to ponder. Considering all these forces at play, from political shifts influencing corporate policies like diversity targets, to AI transforming fraud detection and everything in between, what aspects of financial services do you think will look completely different 5 years from now? And conversely, what foundational elements do you think will remain stubbornly, fundamentally the same? Something to think about. Thank you for joining us on this deep dive, and we encourage you to continue exploring these important topics.